Imagine this. One morning, you wake up to discover that your savings, your investments, even your retirement plans are all vanishing into thin air. It's 2008, and the financial world is falling apart at the seams. Headlines scream panic. Markets in freefall, banks on the brink, global economy collapsing. What's worse, the same banks that played a key role in creating the mess are now begging governments to save them. And governments listened. They didn't just save the banks. They wrote blank checks that would forever change the public's trust in the system. But here's the kicker. While the bailouts may have prevented a financial apocalypse, they left a bitter legacy of inequality, anger, and mistrust. Today we're diving into the great bailouts of 2008. How did they work? Who really benefited? And why, even 15 years later, do these events still shape how we see the world? Let's rewind to the mid-2000s. Housing markets were booming, banks were making record profits, and Wall Street was riding high. It all felt unstoppable. But beneath the surface, a ticking time bomb. Banks had been handing out risky loans to people who couldn't afford them, bundling those loans into complex financial products and selling them like candy to investors. It was a house of cards built on greed and overconfidence. Fast forward to 2008, and that house of cards collapsed. Housing prices tanked, mortgage defaults soared, and financial institutions around the world suddenly found themselves on the verge of bankruptcy. Lehman Brothers, a 150-year-old investment bank, went belly up. Bear Stearns was next. Panic spread like wildfire, and global markets tumbled. Within weeks, it became clear this wasn't just a financial crisis. It was an economic disaster on a scale the world hadn't seen since the Great Depression. Governments were faced with an impossible choice. Let the system collapse and risk plunging the world into economic chaos, or intervene to save it. Spoiler alert, they chose the latter. Now here's where things get interesting. The bailouts weren't just one plan. They were a global effort to prop up the financial system, and each country had its own approach. In the US, the government rolled out the Troubled Asset Relief Program, or TARP. Congress approved $700 billion to buy up toxic assets, those worthless financial products tied to bad mortgages, and inject cash directly into failing banks. In the UK, the government did something similar, even nationalizing some of its largest banks like RBS and Lloyds to prevent them from collapsing. Across Europe, countries scrambled to keep their financial institutions afloat, pumping billions into bailouts. It was like plugging holes in a sinking ship, except instead of water, you had trillions of dollars of debt pouring in. And let's not forget the central banks. The US Federal Reserve, the European Central Bank, and others slashed interest rates to near zero and launched massive stimulus programs to flood the economy with money. The goal? Stabilize the system, restore confidence, and keep the gears of the economy turning. At this point, you might be wondering, why save the banks at all? Why not let them fail and let the chips fall where they may? Here's the thing, these weren't just regular businesses, they were the backbone of the entire global economy. Banks don't just store your money, they're the lifeline of businesses, governments, and consumers. If the banks collapsed, credit markets would freeze. Businesses wouldn't be able to borrow money to pay their employees. Families wouldn't be able to take out loans for homes or cars. And entire economies could grind to a halt. So while the bailouts were deeply unpopular, the alternative, a global depression, was seen as far worse. Here's where things get a little murky. While the bailouts were designed to save the economy as a whole, the benefits weren't exactly distributed equally. Big banks like Citigroup, Goldman Sachs, and JP Morgan Chase received billions in government assistance. Even AIG, the insurance giant whose reckless bets on the housing market helped trigger the crisis, got a $182 billion lifeline. Meanwhile, millions of ordinary people were losing their homes, their jobs, and their savings. Foreclosures skyrocketed. Unemployment hit double digits in some countries. Families were left to pick up the pieces while watching banks, many of which had caused the crisis, get rescued. And then there were the bonuses. In the years following the crisis, Many of the same executives who had steered their banks into disaster received massive payouts. Talk about adding insult to injury. It didn't take long for the anger to boil over. Across the globe, protests erupted. Movements like Occupy Wall Street captured the frustration of a generation. Their rallying cry, "We are the 99%, highlighted the growing divide between the financial elite and everyone else. For many, the bailouts were a stark reminder of a system that seemed rigged. When regular people made bad financial decisions, they were told to live with the consequences. But when the banks gambled and lost, governments stepped in to cover their losses. The result? A deep and lasting mistrust in institutions. Let's talk about one of the most controversial legacies of the bailouts, the idea of too big to fail. Before 2008, this concept was more of a hypothetical. But the bailouts made it painfully real. The biggest banks were so interconnected and so vital to the economy that their failure could trigger a global collapse. So instead of letting them fail, governments propped them up. But here's the irony. The bailouts didn't just save these banks. They made them even bigger. By 2023, the largest US banks held nearly double the assets they did in 2008. Meanwhile, smaller banks and credit unions continued to struggle, and the financial system became even more concentrated. In other words, the very problem the bailouts were supposed to solve, systemic risk, became even worse. So, what did we learn from the bailouts? On one hand, they worked. The financial system was stabilized, and a full-blown depression was averted. Without government intervention, the economic fallout could have been far more devastating. But the bailouts also exposed the flaws of a system that prioritizes the few over the many. They reinforce the idea that the rich and powerful are shielded from consequences, while ordinary people are left to fend for themselves. And while some regulations were introduced to prevent another crisis, like Dodd-Frank in the US, many argue that the fundamental issues haven't been resolved. "15 years later, the scars of 2008 are still visible. Economic inequality has deepened, trust in governments and financial institutions has eroded. And for many, the phrase "too big to fail" still feels like a bitter punchline. The bailouts may have saved the financial system, but they also left millions of people wondering, is the system even worth saving? The bailouts of 2008 weren't just a financial story. They were a human story. A story of lost homes, broken dreams, and a system that failed the very people it was supposed to protect. So here's a question for you. If another crisis hit tomorrow, would you trust the system to handle it? Or would history just repeat itself? Next time on Echoes of Time, we'll dive into the human toll, exploring the families displaced, the communities shattered, and the ripple effects that still linger today. If you found this video thought-provoking, don't forget to like, subscribe, and hit that notification bell.